Coinbase has quietly reshaped the stablecoin infrastructure game, not with a flashy token launch or a new exchange listing, but by stepping into a behind-the-scenes role that could redefine how capital flows into one of DeFi's fastest-growing futures platforms. The exchange is now the official USDC treasury deployer for Hyperliquid, a move that positions Coinbase as the primary gateway for USDC on Hyperliquid. This isn't just another partnership announcement. It's a structural shift in how traders access liquidity, and it could tighten the link between regulated finance and decentralized trading in a way few anticipated. The role of USDC treasury deployer means Coinbase now manages the minting, redemption, and settlement of USDC moving in and out of Hyperliquid. In practical terms, traders funding their positions will route USDC through Coinbase's infrastructure directly, rather than relying on fragmented bridges or third-party channels. That changes the game for speed and reliability. Hyperliquid has built its reputation on low-latency execution for perpetual futures, but even the fastest engine is useless if the fuel line is clogged. Deposit delays have long been a friction point for traders jumping into volatile markets. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. A treasury deployer sits between Circle's USDC reserves and the destination chain. In this case, that chain is Hyperliquid's network. Instead of users bridging USDC through multiple hops, each with its own risk and delay, they'll now move funds through a single, vetted pathway. That reduces counterparty risk and could lower the cost of transfers over time. It also gives Coinbase more visibility into where its stablecoin liquidity is deployed, which may influence future decisions about which protocols get priority access to capital rails. Now, with Coinbase as the conduit, USDC on Hyperliquid could see faster, more predictable settlement times, reducing the window of risk when capital is in transit. The important part isn't just the integration, it's what it reveals about Coinbase's broader strategy. By acting as a treasury deployer, the exchange isn't just providing liquidity, it's becoming a trusted settlement layer. That's significant because it leverages Coinbase's regulatory standing. As U.S. lawmakers advance legislation like the Clarity Act, having a regulated entity manage stablecoin flows adds a layer of credibility that pure decentralized protocols often lack. Still, several key details remain unconfirmed. The announcement originated from Coinbase. There's no official statement yet from Hyperliquid. That raises questions about the scope of the arrangement. Are there exclusivity terms? Is this a trial or a permanent integration? Fee structures, volume commitments, and governance rights have not been disclosed. Until Hyperliquid confirms the partnership on its own channels, the full picture stays incomplete. That uncertainty is a signal in itself. Markets respond to clarity, and the absence of confirmation could slow adoption. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. What to watch next is clear. First, on-chain data will tell the real story. Analysts should monitor USDC minting and transfer volumes to Hyperliquid smart contracts. A sustained increase would confirm that the integration is live and active. Second, trading volume and open interest on Hyperliquid need to be tracked. If this partnership is meaningful, it should translate into measurable growth in platform activity. A spike in funding rates or changes in liquidation patterns could also reveal how improved stablecoin rails are affecting trader behavior across DeFi perpetual venues. This isn't just about faster deposits. It's about trust, access, and infrastructure. The deeper implication of USDC on Hyperliquid is that regulated entities are no longer on the sidelines of DeFi, they're building the rails. And for traders, developers, and institutions alike, that changes the risk calculus. The next few weeks will test whether this integration delivers on its promise, or whether it remains a footnote in a broader battle for control over stablecoin liquidity. The most important signal? Watch for Hyperliquid's official response. Until then, the story is live, but not yet settled.